So, real estate is property, and you can think of it as being two types of property: tangible and intangible property. Tangible, it's the stuff you can touch, a house, a car, that sort of thing. A house is considered real property because basically it's affixed to the land and it's not going anywhere. A car, on the other hand, while it's still tangible, can most definitely be moved and is not tied to any one piece of land. And so we call that personal property. Intangible property, on the other hand, is still something that is owned. It's still property, but it's not fundamentally physical. Ownership of a company's stock, for example, is property, and it may be valuable, but it's intangible because it's a notional claim to a share of any future profits that company might make. In the real estate world, intangible property, it most commonly exists in the form of leases. If you're renting a room in a house, the real estate world actually acknowledges you as owning some aspect of real estate. You may not own the house, but you own the exclusive right to use that room in exchange for a fixed monthly payment each month. And that type of exchange, a lease, is an intangible piece of property, and there are laws which govern your rights to use it. I think the most common thing people think of when they think of real estate is of tangible property. Those types of property you can touch. Tangible real property, though, can be separated into improvements to the land versus improvements on the land. Sometimes land is just raw land, dirt unimproved as it has always been. Other times it's improved because maybe it's been graded, which means like we've flattened it out so it's easier to build on, or perhaps sewer lines have been connected to it, stuff like that. These are what's known as what are improvements to the land. By the way, once those improvements to the land have been done, we tend to call that a site. But improvements on the land are what we're probably most familiar with when we think about real estate. These are structures, buildings, parking garages, any structure that's on top of the site itself. But in addition to thinking about real estate as either the land or the building, it's helpful to think of real estate more generally as being a bundle of rights. There are many things you can do with real estate. You can live in it, you can rent part or all of it out, you can sell it or dispose of it. And if you own it along with someone else, you may have only a part of these rights. So whether you're a broker, an investor, an appraiser, or some other real estate professional, the value of whatever real estate you're looking at, it therefore depends a lot on which aspect of these bundle of rights you're exchanging. And the term real estate can mean different things to different people, including when it comes to what someone actually does when they work in real estate. Presumably, the first thing that comes to mind for many when they say they work in real estate is that of a real estate agent. Brokerage of someone who buys and sells homes. But really, in any given transaction, there are a lot of people involved besides the agent too. There's the buyer and the seller who may be an investor or investors, like an investment management firm or a REIT, especially in commercial real estate, which generally means sales of properties that aren't residential homes. You'll have lawyers who specialize in real estate. You'll have the banks doing the lending, and you'll have the property managers who, after the transaction is completed, actually do the job of running the property. And behind all of this and other transactions, you have government entities involved, like planning departments, who will regulate what can be done with the property, and tax assessors who figure out how much to charge in taxes for each property and who collect that. So there are people, real estate professionals, behind each of these functions. Given all these opportunities for different types of work in the industry, one of the things I want to encourage you to do is to think about which type of these roles fit you best. And it's not just about different job opportunities. The scale of the industry itself is quite large. Globally, real estate represents roughly half of the world's wealth, and about a quarter of all things produced in the United States are new buildings and other improvements to the land. A big chunk of local government revenue comes from taxes on local real estate, and millions of people are gainfully involved in the business. By and large, the use of land in the United States hasn't changed much over the last 50 years, with the exception being the growth in developed land, as you see here. The amount of developed space, that is land that was formerly land and now contains structures on it, has grown about 50% during this time. That being said, total developed land is only about 6% of the landmass in the United States, with the rest mostly equally divided among cropland, federal, forest, and rangeland. Here's a figure that illustrates that further, showing the total value of real estate in the US at about $38.5 trillion. That's just under the total value of businesses in the US, which is 42.9 trillion. And the next biggest market is that of the market for debt issued by the US government at about 17.8 trillion. And a lot of this 38.5 trillion is in the form of housing, as opposed to office buildings, retail buildings, and so forth. So about 25.8 trillion of it. For most individuals in the United States, housing is the single biggest investment that they have. And on average, although many have a house or other residential property, they don't, on average, own it. Rather, it's financed, with the rest being claimed by the bank or other lending institution that actually gave them the money. In these terms, then, when you look at the net equity that the average American holds in their property, it's on the low side relative to the other assets that they have, 401k accounts and the like. So we've covered at this point that real estate is very valuable in the aggregate, but what determines that value? I mean, for any given property, what is it that makes people want to pay this price or that price? As we all know, a house in San Francisco is about, 5 times as expensive, if not more, than one in Central Texas. Much more valuable. We can think about supply differences being one factor there. San Francisco is just under 50 square miles, and a lot of people want to live there compared to Central Texas, which is just under 20,000 square miles, give or take. But let's get into this idea a little bit more, this idea of balancing available supply versus the level of demand by talking about the different user markets, capital markets, and property markets, and how they play a role in determining supply and demand, and therefore price. First, value or price differs depending on which user market you're looking at. I mean, a potential buyer for a warehouse is going to have an entirely different demand curve, for example, compared to a potential buyer looking for a single family house. There's just two different markets. And so supply and demand imbalances need to be looked at the level of the specific property type in order to understand what's driving value. But even if looking at just the warehouse example, you might have one set of warehouse buyers who are immediately and only interested in buying in the outskirts of town, like your Amazon or Walmarts of the world. Whereas an inner city warehouse might have a completely different set of buyers and motivations, like investors that want to redevelop it, split it into residential lots or something. So even among a single property type, value, and hence the prices paid, can be very different. With respect to the user market, you'll have different willingness to pay depending on what the buyer wants to use the property for. So single-family residential property owners tend to want to be as close to work as possible, for example, whereas industrial users tend to want to have specialized things like high voltage capacity or proximity to rail lines, so it's cheaper and easier for them to ship heavy stuff. But on the supply side, you also have the investment objectives of owners who are more financial in nature, who may own a mall, for example, and specialize in negotiating long-term leases. The commercial market for real estate in particular tends to have that separation, and you tend to have most likely an intermediary, someone called a leasing agent, who specializes in dealing with the owner and prospective tenants. They always kind of play the intermediary, and the owner tends not to have interaction with the prospective tenant. But especially when we think about it in terms of the world of finance, real estate markets, they're different. They're an investment opportunity with financial returns, but they're very local. What drives real estate values in one city can be totally different than what's going on in this other city. And as a result, they can have completely different trends in prices and different price levels. But you can contrast that to other markets for financial investment opportunities that you might have come across before, especially commodity markets where, like oil, for example, a barrel of oil, one barrel is really just like any other. It's got the same purpose. I mean, there are different grades and things, and there are at times different country embargoes, but the commodity itself is really interchangeable, and as a result, tends to always have the same price. Not true if you look at a building in San Francisco versus, say, a building in Austin. Different factors driving values for these two different pieces of steel and concrete. And as a result, as prices for the buildings themselves can vary widely, so do rental rates. Whether it's across location or different property types.